Have you ever wondered which tech-focused ETF could turbocharge your investment portfolio? Today, we're setting the stage to compare two heavy hitters in the ETF arena, SCHG and VGT. First, let's look at the bottom line, the end balance of investments. When it comes to the sheer figures after a set period, VGT clearly takes the lead with an impressive end balance of $56,315. In contrast, SCHG trails with a total of $39,404. This significant difference underscores VGT's robust performance over SCHG in the financial arena. Now turning our attention to the expense ratios, which essentially measure the cost of managing these funds, there's an interesting twist. SCHG boasts a lower expense ratio at 0.04%, slightly edging out VGT, which has an expense ratio of 0.1%. This indicates that while SCHG may not have reached the financial heights of VGT, it does offer a cost advantage that could be appealing to cost-conscious investors. While VGT leads with a higher end balance, SCHG offers a slightly cheaper expense ratio. A high return on investment is crucial, but so is understanding the ride you'll endure to get there. Let's delve into the intriguing world of returns and volatility, particularly focusing on SCHG and VGT. When we look at the compound annual growth rate, a key indicator of investment performance over time, VGT shines with an annualized return of 20.15%. In contrast, SCHG trails with a return of 15.68%. This stark difference highlights VGT's superior growth capabilities over the years, making it a potentially lucrative option for those aiming for higher growth. However, with great returns often comes greater risk, manifesting as volatility. In the investment world, volatility is measured by the standard deviation, which reflects the average amount an investment's returns vary from its average return. Here, VGT records a standard deviation of 19.91%, surpassing SCHG's 17.92%. This higher volatility indicates that VGT's investment returns fluctuate more significantly, suggesting a bumpier ride for investors. Understanding this, it becomes evident that the choice between VGT and SCHG isn't just about chasing higher returns, but also about how much uncertainty you're willing to accept in your investment journey. While VGT offers a tantalizing prospect of higher earnings, it also challenges one's nerve with its higher swings in performance. In conclusion, VGT not only offers higher returns, but also demands a tolerance for greater volatility, painting a picture of a potentially rewarding yet more turbulent investment path. Higher returns often come with higher risks. Let's balance the scales with some risk-adjusted metrics. When diving into the world of investments, savvy investors not only look at returns but also how those returns relate to the risks taken. This is where the Sharpe and Sortino ratios come into play. For SCHG, the Sharpe ratio stands at 0.82 and the Sortino ratio at 1.33. These ratios suggest that SCHG provides a reasonable risk-adjusted return. However, it's VGT that really stands out with a Sharpe ratio of 0.95 and a Sortino ratio of 1.62. These figures are not just numbers, they are indicators of efficiency. VGT has managed to provide higher returns per unit of total risk and has shown better performance in managing downside risks compared to SCHG. What does this mean for potential investors? It highlights that while both ETFs offer attractive opportunities, VGT excels in delivering superior returns for the risks taken, making it a compelling choice for those looking to optimize their investment portfolio. VGT continues to shine, offering better returns for the risks taken. Investing isn't just about the good times. How do these ETFs hold up in the worst of times? Let's delve into the darker days of investing by examining the worst year performances and maximum drawdowns for SCHG and VGT. During their worst years, SCHG faced a steep decline of 31.8%, while VGT fared slightly better with a drop of 29.7%. When we look at maximum drawdowns, the figures are quite telling. SCHG's maximum drawdown was also 31.8%, and VGT experienced a slightly more severe drawdown of 32.52%. Moving on to how these ETFs correlate with the benchmark index, SCHG shows a high correlation of 95%. VGT, on the other hand, has a slightly lower correlation of 92%. This lower correlation might be appealing to investors seeking diversification, as it suggests VGT can offer unique advantages, moving somewhat independently of the broader market trends. Both ETFs have their strengths, but VGT shows resilience even during tougher market conditions. After a detailed battle of metrics, one ETF stands out, but the choice isn't just black and white. In our exploration, VGT has consistently shown superior performance compared to SCHG, boasting higher returns and better risk-adjusted metrics. However, this doesn't necessarily make it the universal choice for every investor. VGT's higher volatility and larger drawdowns can be a concern for those with a lower risk tolerance. On the flip side, SCHG, with its lower expense ratio and slightly less volatility, presents an appealing option for investors looking for a more conservative approach. While it may not hit the high peaks like VGT, it offers steadiness and requires a smaller fee, which can be crucial for long-term investment strategies. For those leaning towards maximizing growth, VGT is the clear frontrunner. However, for investors who prioritize stability and lower costs, SCHG might be the more suitable choice. Whether you seek growth with VGT or a more balanced approach with SCHG, make sure your choice aligns with your investment strategy and risk tolerance. Remember to subscribe and comment on what fund you would like me to review next.